I have to say, this is perhaps one of the most anticipated videos of the About to Retire series. And the reason I know that you're going to feel anxious about it is, one, do you have that feeling about risk in the markets? Do you get that feeling that you could lose money investing? Maybe you've invested money before and you've lost money. And that was a small amount of money compared to what you're about to invest now, because now it's pretty much your entire life savings. So are you feeling anxious about it, nervous, or maybe even afraid that you could run out of money? What happens if there's another market crash? How can you make sure that this money is protected? Now, the other thing that could be bugging you is if you do run out of money, what takes place next? Who do you go on to? Who do you call on for assistance? Well, in this video, I'm going to be guiding you on the secrets to ensure that you are able to invest with absolute confidence. Now, because a lot of people lost money investing inside of these vehicles or investing in the markets, I want to share with you 3 don't do secrets. So 3 secrets that I want you to promise to me right now that you're going to make sure you do not do. And this then is going to help you in order to make sure that the framework for this runs well. Now, if you've not watched the previous videos in the series, this series is all about ensuring that you retire comfortably. So I encourage you to watch that, especially the one on tax, because each video builds on the next. Now let's get started straight away. I want to guide you on something key, which is a framework when it comes to investing. When you understand this, whatever we're going to do going forward on the secrets, it's all going to make a lot more sense. Now, let's assume that the pool that I'm drawing here is your retirement capital. Now, earlier in the video, in the series, I spoke about 5 different options that are available for you in order for you to earn an income for life. I'm assuming that you've watched that already. If you haven't as yet, it's okay. You can complete this video and go back to watch. But I am working on the option that allows you to invest capital where you are in control of this, right? Not the option where the insurance company is investing on your behalf. So let's take a look. We know that when you invest money, you have to get some kind of return, right? And that return is going to help to grow this capital. But we also know that when you invest money, you're going to have to take some kind of income. So you have to draw an income from this. And in addition to that, we've got to factor whatever the insurance company's costs are. So what I've drawn for you now is a very good framework. It gives you an understanding as to how the investment works, right? Now, why is it critically important to ensure that you're investing well? Look, the income that's coming out drops your capital. You agree? And the cost from the insurance company also drops your capital. So the only element that's making this capital to grow is the return that's coming in, unless you're going to keep putting money in, right? But you just have a finite amount of money that you want to invest and grow. You're not going to start work again in order to grow this capital. So what's taking place is if the return is performing well, then you know that this capital can grow. And let me use an example. Let's assume that the return that comes in is 50,000. So I'll use that in my example, 50,000 coming in. And let's work on your income to be 60,000. Now, again, I'm using an example because I want to illustrate a point, right? And let's say the cost for your investment works out to 3,000. So notice what's taking place. 63,000 is what's coming out here, right? Because I'm adding the 2. And what's coming in is just 50,000. So the difference, where does that shortfall come from? You got it. It's coming from your capital, which means your capital reduces. And over a period of time, this could leave you feeling extremely uncomfortable. You could run out of money. So now in this video, we're focusing on the return aspect. And let's go with the first secret that I want to share with you, which is don't rely on traditional risk profiles. Now, let's first understand what is a risk profile. When you're engaging with an insurance company, financial planner, financial consultant, they're going to want to find out whether you are a conservative investor, whether you are a moderate investor, or you are an aggressive investor. Now, you could have variations of these 3. For example, you could be conservatively moderate. You could be moderately aggressive. So, you know, there's sort of 5 different risk profiles. Now, I'm personally not a fan of it, so you can be the judge at the end of it. But for me, the reason I don't like the traditional risk profiles is it sort of, I feel it's something that the insurance companies have done to protect themselves. Yeah, they've sort of done it in a way where they don't want to get you to complain. They want something legal that is available to show that, hey, you've signed this, and because your profile is conservative, we invested you into conservative money. Because your profile was moderate, we put you into moderate funds. So why I'm saying I want you to stay away from this is you are an individual, see? And the risk profile is very general. It's based on stats. It's pretty set. If you come out as a moderate person in the risk profile, or you come out as an aggressive person, it might not be the correct match for you, because an aggressive person might be someone who is investing high risk. But you might be the type of person who feels, hey, this is your retirement capital. You've worked your entire life for it. You don't want to lose a cent. You see? So I'd rather not focus on the traditional risk profile. I'd rather focus on your specific circumstances. So what makes you unique? So when you get the understanding of the investment, you now know, okay, you're not just choosing funds for the sake of it. You're choosing funds that are based on you and what makes this beneficial for you. And that takes me to the next one. Before we go though, the risk profile, remember, is a series of questions. So let's say they could ask you 10 questions or 20 questions. At the end of it, the outcome is going to be that you're either conservative, moderate, or aggressive. You're going to be one of those profiles. And therefore, the funds that you're going to be investing money in must be linked to that. So if you're a conservative person, then they're going to limit you to conservative funds. You don't really want to go into aggressive because your profile is coming out as conservative. What's secret number 2? Don't get caught up in long-term returns. Now, why this is key? What I've observed is the markets ebb and flow, right? So we have this type of experience happening. There's times when the markets are doing well. There's times when the markets are not doing well. But over a period of time, I want you to observe what I've just drawn for you. Notice where we started and notice where we finished off. When you focused on the long term, you might just see what happened in the beginning and what happened in the end and how nicely the money grew. The challenge though is, and let's just say I use a 10-year term for this example. So let's say this is 10 years, 5 years, 1 year, that's 0. The challenge is this. In order for you to get to 10-year term, you have to pass year 1, you see? And usually in year 1, you would get to see whether this fund is going to be good or not good. By that, I mean, what if in the last year, the fund actually delivered a negative return? It was incredibly unstable. See, lots of market fluctuations. Now, if you can't make the first year, you're never going to make the 10-year period. I'm going to say that again. If in the first year of the fund, so if you're looking at the fund performance over a 1-year period, and you can see that there's some loss, the loss might be small, but because your pool of capital is so large, the corresponding RAND value loss for you could be significant. Let me illustrate this point, right? Let's say your retirement capital is 6 million. You might see that over a 10-year period, the fund performed phenomenally well, and the fund gave a return of, I'll say, 12%. That was your return over that period. So when you look at the average return over the 10-year period, that is phenomenal, and you're going to want to invest the money there. What I'm saying, the secret behind this is, you want to also pay attention to what happened inside the 1-year period. Because inside the 1-year period, so this is 1 year, what if the return of that investment was actually minus 3%? Now, the minus 3% doesn't seem like a high value when we're looking over a long period how this grew to 12, through to a 12%, right? But I want you to see what's minus 3% of 6 million. We'll do the calculation together, right? I'll pull up a calculator for you to observe it. So here's 6 million minus 3%. That's 180,000 Rand. So if you had 6 million Rand, you just now had a drop of 180,000. So let's put this into perspective. Imagine you are getting an update from me. Let's say I'm your financial planner. I'm giving you an update. and you're starting to see, hey, the money's dropped from 6 million, it's dropped 180,000. How would you feel? Would you be okay to continue investing because now you know this is a long term? Or would you start to be incredibly worried? This is your entire life savings. You just lost 180,000 in a flash. What if you lose more? You see, now it's human nature, especially when you've grown this entire capital for your entire life and you don't have any other source of income. Now you want to protect this money. You want to make sure that this pool, this nest egg that you have is growing and growing well. So why I'm saying this is the key secret is I've observed many retirees often get this wrong. They're not explaining this properly. And when that happens, if in the first year you don't like it and you now want to move to another fund, you can't get the long-term returns. And this is why I came up with this secret. If you're going to choose a fund, if you're shown a fund that's over a 10-year period and you can see it's performing well and you go in, and after the first year you come away from it, I want you to see you won't be able to get the full 10-year growth because you came away at this point. You're not going to get the balance of it. So you want to make sure you understand this properly in the beginning. And I'm not saying that you have to have a loss, because that's something that needs to happen in the beginning, which takes me to my next point here. Critical point is the last secret I want to share with you. This is, you don't invest until you're 100% sure. Now, this seems a bit weird, right? But maybe you are feeling like you don't know a lot about the markets, you don't follow stocks, you don't follow shares, it's not your forte. You're trusting the financial advisor, you're trusting the person that you're dealing with. Even it could be me, you're trusting me to ensure that I'm giving you the right advice. And I'm saying to you that you can't invest this money until you're 100% certain. So whatever the fund that is being recommended, I want you to start to question. So you have, maybe you recommended to fund A. I won't use the fund names of the companies, you can choose. This could be Allen Gray or Mutual, Sanlam, Coronation, Discovery, Momentum, any of the funds. But you want to have a look at why that fund is being chosen for you. Why is fund B being chosen for you? Why is fund C being chosen for you? How does that match what is important to you? You see, why is it fund A that's being suggested and not fund Z? See, you want to know, how did the financial planner go about giving you that guidance? Now, I have a specific process in which I do this, where I sort of create a funnel. I get to know exactly what you want to do for your retirement. Once I understand that, I then do some research on the marketplace to see which of the funds then match. So it's almost like a filter. There are hundreds of places to invest money. Each time I know a particular goal of yours or a particular like your profile as such, and what it is that you want. Let me say your goals, not profile, but what it is that you're wanting. I then go back into the fund and I create a filter, and I keep filtering this down until I'm able to come up with something that is suitable. Then I can present to you. But here's the key: you still don't invest until you're 100% sure. You see, so you want to go and analyze the fund. You want to look at what I showed you over a 10-year period. You want to look at returns over a 1-year period. Is this something that's going to be suitable for you? Now, if you get this work done properly in the beginning, you're laying a rock solid foundation for the future. What you don't want to do as well is hop. You don't want to invest some money, then realize, hey, you've made a mistake and now you want to change to another fund. It's possible to do, but then it means the foundation that happened wasn't correct. And that just becomes a case of you chasing your tail. You're going to run around never finding something that is suitable, which is again why I say, please, you don't invest until you are 100% sure that the solution that has been created for you has been customized. Now, if you don't want to make a mistake and you want to get the shortest route in order to get your success, you're welcome to reach out to me for additional support. There is a profile of client that I work with, so I can't guarantee that I'm able to assist you. But if you reach out, I'll be able to share with you what that profile is. And if it's a good fit, we can then look at how we can help you going forward. But in any event, I want you to share with me, have you found this video helpful? Which of the 3 secrets would you be implementing? And is there something else that you need guidance on when it comes to investing? So comment below so that I'm able to understand. If you found the video helpful, please click the thumbs up sign. And remember to share the video to your friends and family who are about to retire so that they're also able to gain from as well. I got something really, really special for you coming up for the next video. Looking forward to seeing you then.